You already know this decision isn't a one-way door, so why does it feel like it is? Let's say you invest £100,000 this week, and 3 weeks later, the market is down 12%. What do you feel? Most people don't just say, that's fine, I'm in here for the long term. They say, I knew I should have waited. That imagined moment, that feeling, is what's keeping the money still. This video isn't going to tell you just dump it in the market and stop worrying, and it's not going to pretend that committing this much money feels easy. It's about what a run actually looks like in numbers over time, and whether the outcome you fear the most really means what you think it means. Because once you see that clearly, this decision starts to feel very different. If you're still working through how to construct a portfolio, I've linked that video below. This one starts after that. Here's what I think is really happening. This isn't a knowledge problem. It's about what happens if the outcome is worse than expected and whether you can defend that decision to yourself. There's probably a number sitting somewhere, a savings account, a cash ISA, a current account with more in it than usual. You've thought about it, done the research, opened the tabs you haven't closed. The cash still sits there. That's not indecision, it's a different kind of problem, where knowing your options doesn't make the decision feel any safer. Most people with this feeling haven't acted yet. I had. And what I felt on the other side is exactly what they're trying to avoid. In April 25, markets turned down after a month of steady gains. I thought I was doing the right thing, buying the dip. I moved quickly, put in my bonus and tax refund. It felt like a good decision, maybe even a smart one. But then the slide kept going. Within weeks, several of my accounts went into the red, and that smart feeling disappeared fast. It felt like I've moved a large amount of money and I watched it shrink. Not gradually, quickly. Like something I'd built over time just dropped in front of me. So I did what most people do at that point. I looked for an explanation, and the headlines didn't help. Retail investors pile in while institutions cash out. That one landed badly, because suddenly it felt like people moving out knew something I didn't. Like I'd missed something obvious. And that voice, the one that says, this time is different, and this time it might not come back, grew louder. On paper, I knew how this works. I've been investing for years. I understood market goes up over time, but sitting there, watching it drop, that knowledge didn't help with the feeling. Because this didn't feel like a loss, it felt like a verdict. The distinction many people are making without quite naming it is this. I can tolerate being unlucky, but I can't tolerate being wrong. Unlucky means the market moved. Wrong means I moved it at the wrong time. That's what creates the one-shot feeling, not the mechanics of investing, the meaning assigned to the first potential outcome. Let me show you with some data what a run actually looks like. But before that, one thing needs to be true for this to apply. This is about capital with a long-term horizon, money that doesn't need to perform on a 2 to 3 year schedule, pension, long-term ISA, or a windfall you're not planning to spend soon. If you haven't worked out the capital allocation structure yet, what needs to stay accessible, what you are building towards, that question comes before this one. But if the foundation is there, and this money has a decade or more to work, this changes the frame. Let me show you the scenario you've probably been replaying. Imagine you invest at the worst possible time, not occasionally, consistently. Every year, you invest at the exact market peak just before the drop, the most unfavorable entry point imaginable, repeated for 40 years. This isn't a thought experiment, it's a real model scenario based on the analysis from Personal Finance Club. This data is US-based, but the pattern is consistent across developed markets, including the UK. Here's the data. 3 investors each invest the same amount into a broad market index, about $240,000 US over 4 decades. The only difference is timing. Let's name the first person the worst timer. They invest regularly, but always at the worst moment, right before every market drop. The next one is an immediate investor. They invest as soon as money is available. No timing, no waiting. Last one is the best timer. They wait and somehow invest at the exact bottom every single time. One thing to notice before revealing the outcome, what the best timer is doing isn't just difficult, it's impossible. Not only you have to buy the dip, you also have to recognize the bottom in the moment and do that again and again. .com, financial crisis, COVID, some of these crashes lasted for years. And you wouldn't just need to get the drop right, you'd need to get the recovery right as well. And yet, even under those conditions, the best timer still doesn't come first. The immediate investor wins. So not the one who got the perfect timing, the one who didn't try to. The worst timer, who gets it wrong every single time, still ends with over $2 million. Now, here's a number that actually reframes the decision. Someone who stayed in cash the whole time, earning around 3% nominal rate, ended with about $463,000, less than a quarter of what the worst timer has built. So this isn't really about right versus wrong. It's about staying out versus staying invested. Because even getting the timing wrong over and over again led to a far better outcome than never really entering the market at all. That's what wrong actually looks like here. You're probably wondering how. How does someone who just invests immediately, no timing at all, beat even perfect timing? Here's the main reason. Markets don't recover gradually, they recover in bursts. And those bursts cluster around the most volatile, most frightening periods, the exact moments where most people are in cash, waiting for things to calm down. Miss the 10 best days over a decade, and you return roughly halves. Those days don't announce themselves. They arrive inside the periods you were waiting to be over. So anyone trying to wait for the right moment ends up missing part of the recovery. The immediate investor doesn't. That's why consistent exposure wins, not because timing doesn't matter, but because being out of the market during recoveries costs more than being in during the drops. And there's one more thought that usually comes up here. This time is different. And that feeling is real. Every downturn feels different from the inside. .com, tech will never recover. Financial crisis, the system is broken. COVID, the economy is shutting down. Each time people believed it, and each time markets recovered. Not smoothly, not predictably, but consistently. So here's what I want you to take from this. Waiting feels like the safe choice, like you're protecting yourself until the conditions improve. But it's not neutral. It's a position with its own cost. You're not choosing between something risky and something safe. You're choosing between two different kinds of imperfection. One exposes you to early drops, the other exposes you to missing recovery. Neither feels comfortable, but only one of them compounds to serious wealth over time. That's worth sitting with before you decide that waiting a little longer is the cautious move. So bring that together. Even perfect timing doesn't win, and trying to achieve it is what causes most of the damage. Knowing this won't stop the feeling. When your accounts drop after you invest, it will still feel like a verdict, but that's not what it is. The data doesn't remove the feeling, it changes what the feeling means. That drop is no longer evidence that you got it wrong, it is just part of how this works. That's the shift. But understanding that is one part. Managing it in the moment when the number is falling and the headlines are loud, that takes something more than knowing the data. That's where systems matter more than display. Display says, I'll hold steady when it drops. Systems say, I've already decided what I'll do when it drops, so I don't have to rely on willpower in the moment. In my book, The Compound, I go through the specific systems for exactly that situation, ways to stay invested when the feeling overrides the logic. There's a third layer worth naming, because even the systems are, in some sense, preparation for something only experience can give you. I knew this data when my accounts went red in April. I had the systems, I still felt it. What builds conviction is the experience. Staying invested through a real drop, watching the recovery happen, that changes something data alone can't. Which means the most useful thing this video can do for you isn't resolve the feeling completely, it's to get you invested so the experience can do the rest. And if anything, most people find that after their first real drop and recovery, the feeling has less power on them than it did before. Not because the market changed, because they did. One practical question that often comes up here, all at once or over time? The evidence favors lump sum. Markets rise more than they fall, so more time in the market helps. Data from Vanguard shows lump sum beats gradual investing around 2/3 of the time, even when markets are about to fall. But if spreading it over a few months means you can actually do it, that's fine. Both beats waiting. The method matters less than it feels. Before this, you were trying to get it right. Now look at what right actually required. The best timer had to identify the exact bottom of every crash, including the ones that lasted for years. Get back in at exactly the right moment. Do that again and again across .com, the financial crisis, COVID, and still came second. The immediate investor did none of that. No timing, no stress, no research into when to move, just consistent exposure. And they won. So the question isn't, can I get this right? It's this. Why would you choose the harder version when the easier one delivers a better result? The boring approach, the passive approach, the one that requires the least from you emotionally and intellectually, that's the one that wins. And if the worst case, someone getting it wrong every single time for 40 years still builds a serious wealth, then what exactly are you protecting yourself from? The decision in front of you hasn't changed, but now you can see the game you're actually playing and how simple it is to win it. If this reframes the fear, but you're not sure how it applies to your situation, your timeline, your accounts, what this money should do, that's exactly what the allocation diagnostic is for. It's a focused session where you work through your decision properly, your structure, your constraints, your call. The link is in the description. And if you want to see how this turns into an actual portfolio, what each part of the money should be doing, watch this next. Thanks for watching. I'll see you in my next video.